Hello, everyone. Hope you're all doing well. My name is Arjun Nagarajan, and I'll be your host for this E.M.I series going forward. E.M.I standing for Economy, Markets, and Investment. Let's jump into the E segment of the E.M.I, which is Economy. We'll start off with a quick macro watch list. A macro watch list with two large components, what you have to keep an eye out for, keep a tab on for this particular month, the month of July. The first will be, in order of importance, the first will be the budget, and then how are the bond inclusion narratives playing out? What are the numbers looking like? These are two broad pointers we are actually looking at for the month of July. So we'll start off with the budget. Now, we had the budget that was presented in February, the interim budget. Now, post the interim budget, a lot has changed. The political equation in the center has changed. Instead of a sweeping majority, the government is currently at a coalition. So a coalition government of sorts does have its pressures on the budget and the budget numbers. But the biggest positive has been the fact that despite the fact that it's a coalition government, the narrative is unlikely to change. The narrative is likely to remain pretty much the same. The focus on policy, the policy momentum will not really see a change. Now, apart from the other details on the budget, there are 5 key pointers you have to watch in the budget, 5 numbers. Now, these 5 numbers will give you a sense as to how the budget is panning out and how to read the budget. The first number the markets immediately look at when the budget is presented is what is your fiscal deficit number looking like. And what determines the fiscal deficit number? The nominal GDP number. So your fiscal deficit is your fiscal deficit divided by your nominal GDP. So whatever your nominal GDP is, if your nominal GDP is inflated, you can show a smaller fiscal deficit. If your nominal GDP is realistic, it might give you a more real picture of your fiscal deficit. So the first number that you have to keep an eye out for, like you see in this table here, is the nominal GDP number. Are the nominal GDP numbers realistic? So in the FY25 budget, the interim budget, the government had projected somewhere around 10.5% nominal GDP. So a very simple way of looking at nominal GDP is your real GDP plus inflation. So if you're having a 6% real GDP and a 5% inflation, you have 12% nominal GDP. Now, inflation has actually been fairly low. When you say inflation, wholesale inflation. So you have 2 types of inflation. You have retail inflation and wholesale inflation. When you look at the inflation in the GDP numbers, or what you call the GDP deflator, it is a mix of wholesale inflation and retail inflation. It largely comprises of the wholesale inflation number. Wholesale inflation number has actually been fairly weak in FY24, given global commodity prices have actually been lower on a year-on-year basis. But going forward, that normalization has already started happening, and WPI is now in positive territory. So if you see somewhere around a 10.5 to 11% nominal GDP number, that would be a more realistic number. So this is the first number you have to look out for. Is the nominal GDP number projected at around the same that it was projected at for the FY25 interim budget? This is the first. The second, again, is your fiscal deficit number. 5.1 was the fiscal deficit that was targeted for the interim budget. Is that changing? Is that 5.1 going up or going down, or is it remaining the same? Now, we feel 5.1 would remain pretty much the same. It might not really change, but there is still a reasonable probability where the government can surprise, positively bring that possibly closer to around the 5%. There is still a moderate probability of that happening. Now, why would the government want to do that? You remember we talked about bond inclusion a few minutes ago. We said bond inclusion is also a narrative you have to very closely watch this month. So from that point of view, the fiscal deficit number becomes important. We'll talk about that in another couple of minutes. So this is the second thing you need to keep an eye out for. Third, what is your tax assumption like? So your tax revenue, your net tax revenue, you will always have to look at it. When you look at a budget, always look at tax revenue numbers, not in year-on-year terms. For example, if you look at year-on-year, the government had actually budgeted a 12% growth in tax revenue. Now, these numbers will change if your FY24 actual numbers get revised and get changed into the actual numbers. These year-on-year numbers will change. But what is more important for an economy is to try and see, is there tax buoyancy? So when you say tax buoyancy, as a percentage of GDP, your tax collections, are they going up? So for example, if your nominal GDP growth is 10.5%, for tax revenue as a percentage of GDP to remain constant, tax revenue will also have to grow at 10.5%. Anything above 10.5% will mean that as a percentage of GDP, your tax revenue collections, your tax buoyancy is seeing an uptick. So that is the most important. So in FY20 from 24 to 25, the budget had sort of priced in a marginal sort of a pickup in tax buoyancy. Is that happening? Is another number that you have to look out for. This is the third. Now the fourth and the fifth are focused on the expenditure side. Now you can always break up expenditure into two types. One is revenue expenditure and capital expenditure. And if you can see here, the total expenditure budgeted in the interim budget was roughly around 48 lakh crores. Of that 48 lakh crores, a large part of it is revenue expenditure, and around 11 lakh crores was capital expenditure. Now, as a percentage of GDP, remember, the focus should always be on percentage of GDP, not as much on the year-on-year numbers. As a percentage of GDP, is your revenue expenditure number going up? And more importantly, is your capital expenditure number, 3.4% of GDP, is that remaining the same or is it going up? I think these are the 5 key numbers you will have to look at when the budget comes out and the final numbers come out. These are the 5 numbers that will tell you what the budget is like. So how do I read these 5 numbers? How do you put these 5 numbers together? First, is there a realistic nominal GDP assumption? Second, is your fiscal deficit getting better, or is it the same as it was projected in the FY25 interim budget? Third, are you seeing tax buoyancy? Tax buoyancy would mean that the government is expecting the economy to also continue at a good steam and see some progress. And lastly, what is the expenditure mix like? The budget had a fair bit of a focus on capex. When the interim budget was announced, they pushed up the capital expenditure numbers by roughly around 17%, taking it to 3.4% of GDP. So this mix, is there betterment on the capex number, or is it exactly the same as the interim budget had projected? So these are the 5 key pointers you will have to look at from a budget point of view. Now, apart from these budget numbers, from a budget narrative point of view, what can come, what can change, and what has actually changed in the last month or two? Now, every year the RBI announces the dividend. And this year also the RBI announced a dividend. So the RBI announces a dividend for its financial year that ended in March. Now, when the payout happens, the RBI payout happens in the financial year of FY25. So somewhere in the month of May is when the end of May is when the government would have also received a payment from the RBI. Now, what was a big surprise for the markets is that the markets had priced in somewhere around 850 billion. It had budgeted in 850 billion of dividend from the RBI for its FY25 budget when it prepared the interim budget in February. But the actual number that came out was roughly around 2.1 trillion in RBI dividend. Now, this is an excess of roughly around 1.25 trillion. Now, from the interim budget to the budget that will be presented on the 23rd of July, there is an extra amount of money that the government now has, which is 1.25 trillion. Now, the question is, where can this 1.25 trillion get spent? Now, this is where the election result comes into picture. The fact that there is a coalition government, and possibly the fact that the government might see there to be a little more need to spend a bit more on the revenue expenditure side while not really compromising on the capex number. So one thing that one can say for sure is this political dispensation has been fairly prudent on the fiscal side, has been fairly prudent on the consolidation, of the fiscal consolidation front as well, and has been making every effort to give a bump up on the capex front. They understand that from a sustainable point of view for the Indian economy and for growth, focus on capex becomes very important. Now, 3 areas where you are likely to see focus of this 1.25 trillion is one on PM Kisan, on MGNREGA, and your PMAY. So your PM Kisan is largely income support to farmers. Your MNREGA is rural employment guarantees, and your PMAY is Awas Yojana, is housing for rural and urban. Now, these 3 are likely to see a fair bit of allocation. So going by market estimates and analysts of other economists, you can expect the 600 billion that was budgeted in the interim budget to go up closer to around 900 billion or even higher. We don't really know the exact numbers, but these are numbers that you get to hear in the markets. MGNREGA going from 860 billion, probably higher, to closer to around 900 billion or above, and PMAY going from 800 billion, again closer to around 900 billion or above. So these are three areas where there's a very likely possibility of this extra 1.25 trillion of RBI dividend getting spent. So a quick recap on the budget part. 5 key pointers you need to really look out for in the budget. One is, what is your nominal GDP growth assumption in the budget? Second, what does your fiscal deficit number look like? Third, what is your income, your tax revenue as a percentage of GDP? Is there tax buoyancy that the government is pricing in? Fourth, what is your revenue growth assumption like? What is revenue as a percentage of GDP? Is it actually moving down? Revenue expenditure, I'm sorry, moving down? Is your capital expenditure, is that going up from a percentage of GDP point? I think these are the 5 pointers. The second thing to watch out for is this extra 1.25 trillion that the government has received from an RBI dividend point of view. Where all is that incremental spending getting reflected? We feel PM Kisan, MGNREGA, and PMAY are 3 key areas where you can possibly see this incremental revenue being spent. Now we'll come to the bond market. Now we'll touch upon what we just spoke about, the 5.1% of GDP fiscal deficit. Now, if the government, we don't really know what the exact number is going to be. We're assuming it's going to be a 5.1%, but there's still, like we said, there's a moderate possibility that the 5.1 can come down to by 10 basis points to around 5% or so. If that does happen, that will be a positive for bond markets, mainly on account of the fact that if your fiscal deficit comes down by 0.1% of GDP, the government will have to borrow that much lesser from the bond markets, which also frees up money for corporates and for non-government entities, and probably also quasi-government entities, to tap the bond markets. Now, one thing we really need to understand, so the chart in front of you is your India 10-year bond yields from August 2023. You can really see here that from October of 2023, you can see directionally the bond yields have actually been coming down consistently. A lot of reasons why bond yields come down. So one is your borrowing numbers. If the government borrows lesser. Second is if crude prices continue to come down, inflation continues to come down, if there is ample domestic liquidity, if there is more currency stability, and if there is a lot of money, FII flows coming into the bond markets, you generally see this trend happen. Now, one key thing that really changed around October of 2023 is, for a few years now, the markets have been expecting JP Morgan bond inclusion, India being added to JP Morgan's emerging market bond indices. The announcement, the confirmation happened somewhere around October of 2023. And it took a while for the markets to also get a sense as to how this would impact bond flows. And that was combined with the fact that crude prices were coming off. You were seeing incremental stability on the currency. And from around November 2023 on, we started seeing from almost above 7.35% on bond yields. You've seen bond yields come down consistently. And it's currently trading just under 7%, around 6.98, 6.99 as we speak. Now, one positive bump up that it received was a big surprise in the interim budget. When the interim budget was presented, the government was expected to deliver a 5.9% fiscal deficit in FY24. It really surprised markets by delivering a much lower fiscal deficit target for FY24, nearly 30-40 basis points lower. And it continued to project fiscal consolidation for FY25, showing a 5.1% of GDP. So that was one big positive. And just after the JP Morgan bond inclusion news, around 5-6 months later, you had Bloomberg bond inclusion also coming through. Now, why is all of this important? So we'll talk about that in just a minute. Now, the big focus in the debt market space and bond yields has been all through the month of May. You've seen a sharp drop in bond yields from roughly around 7.2%. It's come down all the way, nearly around 20 to 22 basis points consistently. Largely, one, you saw core inflation continue to come down in India. Core inflation currently, as we speak, is at record levels, record low levels. Then you had a lot of RBI's bond buybacks. You had the bumper RBI dividend that we just spoke about a few minutes ago. Then you had news flows from rating agency S&P, a surprise, a positive narrative where they upgraded India's outlook to positive from stable. And FY24, the fiscal deficit number came in much lower. Now, these were a string of news flows that came in and around the end of April and May that led to bond yields coming down lower. Now, the question is, from here, what can pull bond yields lower? Now, one, like we mentioned, aggressive fiscal consolidation that can really bring bond yields lower. Second, if there is a significant ramp up in bond flows on the back of this bond inclusion narrative, that can really help. If US 10-year yields start coming down sharply, that can pull down India 10-year yields as well. Now, markets are now talking about a Federal Reserve rate cut cycle starting in September. We feel maybe early 2025 or December 24 is more likely, but nevertheless, the markets currently are pricing in start of September. As we speak, they're attributing a 70% probability of a September Fed rate cut. We see that unlikely at this point in time, but nevertheless, for whatever reason you continue to see a sharp drop in US 10-year yields, you will start seeing India bond yields also move, at least directionally in that sense. And lastly, any continued stability or softness in crude prices, that can also give one positive, that can also give a positive spin, rather a positive layer for bond deals in India moving lower. But of all of these, I think these two would be the most important to look out for, at least in the near term. Fiscal consolidation number, that 5.1, is it going lower or is it staying where it is? Is there incremental confidence on the fiscal consolidation path? Is the quality of expenditure much better in the budget? These are some important questions to keep an eye out for. Second, what are the bond inclusion flows looking like? Now, we'll just take another minute on the bond inclusion flows. Now, the chart on the left talks about how much of bond inclusion money has come into India. Now, when we say bond inclusion, when foreign investors are bringing money into India, you will largely see it as FII investment in debt. So year to date, 2024, you've seen roughly around $10 billion of money, $10.6 billion of money that has actually come into FII investment in debt. Equity has seen roughly around 1.9 billion. But of this 10.6, not all of this has come into all the FAR bonds. So FAR is your fully automatic route. So ahead of the bond inclusion narrative, the RBI had sort of carved out a set of bonds, a specific set of 29 bonds that were under the fully automatic route, where FIIs would actually bring in money with fairly less amount of restrictions. They could actually bring in money when they wanted and take out money when they wanted. So the FAR segment was carved out for this purpose. And for the bond inclusion purpose, the specific bonds are these 29 bonds, which roughly has a duration of just about 7 years or so on average. Now, of this 10.6 billion that FIIs have brought money into India, a large chunk of it, $7.1 billion, has gone into these FAR bonds. And now, if you look at FAR bond investment in India, you've seen from September 2023, when the JP Morgan bond inclusion narrative started, you've seen the money that goes into FAR bonds see a consistent pickup. And in the month of June, you've seen a fair bit, roughly around almost $2 billion has gone in just into this FAR segment. Now, it is also important to look at this in perspective. As a percentage of outstanding G6, how much do foreign investors hold? It's not a very large number. It's a small number. 2.6% of outstanding G6 government securities, foreign investors hold only 2.6%. Of this FAR segment, they hold around 4.7%. Now, you compare this with how much foreign investors hold of outstanding equity in that segment. Roughly around 16% is what FIIs hold in Indian equity. So given that FII holding of Indian debt is fairly low, is just under 3%, there is a fair bit of an upside that is yet that we are yet to see on the bond inclusion front. And with incremental allocations that FIIs will be doing for Indian debt. Now, why is there so much of focus on bond inclusion? Now, bond inclusion is seen as a very big positive for the Indian economy. And if the reception is fairly positive, markets are expecting roughly around $25 billion from now to the next 10 months of money that is expected to come into India, into this FAR segment from a bond inclusion point of view. Now, a successful bond inclusion will help India see all of this. You will see pressure coming down on the center's need to borrow money from the market. You will see, which will lead to more space for companies to borrow. The flow of money will help the RBI to mop up more forex reserves, really increasing its FX reserves and increasing its import cover. The RBI will also have an opportunity to sort of, when they buy the FX reserves, it releases domestic liquidity into the system that can also ease pressures on short-term rates. These are roughly the positives from a bond inclusion. Now, where does India stand at this point in time? India has stable fundamentals. Its currency has been really very strong compared to emerging market peers. It really tops the other emerging market peers on the currency stability front. India has one of the largest local debt stock in emerging markets, which gives a lot of comfort to the foreign investors in trading in India debt. 9% of local emerging market debt trading volumes. And if you're looking at it from a bond point of view, the holding, like we mentioned, there's ample room for this 2.6% of FII holding to continue to move much higher. Now, a lot of analysts and economists estimates, they expect this 2.6% to go up to as high as 4.4% of outstanding, probably around the same time next year. So from a bond inclusion point of view, the reason it is extremely important to look at what the bond inclusion inflows are like, it will determine where your yield will also be at the end of the month or in the months ahead. Now, how much of money have we received month to date from a bond inclusion point of view? We've received roughly around, I think, the first week or so of the month of post the inclusion. 28th of June is when India was added in the JP Morgan bond index. And since then, around the first week, we've roughly seen around 0.7 billion come into India debt. And if you're looking at it at the FAR segment, we've received around 0.4 billion. Now, if you extrapolate this does look like a comfortable number for the month. So by the end of July, I think it is very important to try and see what this number is looking like and track it on a monthly basis. That will give us a sense as to how attractive India bonds are and remain to be for foreign investors. I think that we come to the end of the first segment, which is E, which is economy. Now, 4 short indicators that you have to look at. First is your 4-quarter trailing GDP. You can see around a 50 basis points increase in the March quarter. Now, 8.2% is not going to stay 8.2% consistently for every single year. You will see some moderation in growth as and when global growth also sees a moderation. But nevertheless, the point here is that India growth continues to remain fairly strong. A most important, a very relevant indicator to look at is your PMI numbers that come out every month. For the month of June, we've already seen an uptick in both services and in manufacturing, and sub-indices within your manufacturing and services have hit records within your PMI numbers. And your 50 is generally considered an important threshold. Any PMI number above 50 is considered to be in expansion mode, and anything below 50 is considered to be in contraction mode. So from a PMI point of view, India is doing fairly well. You aren't really seeing any particular weakness there. From an E-way bill momentum point of view, these are in absolute numbers. You can actually see where the month of June stood. From an E-way bill numbers point of view, we touched the 100 million mark, well above where E-way bill numbers were in FY24 and FY23 and in FY19. So you can see a fair bit of momentum continuing. Another positive that happened in the month of June was you saw India's current account that normally stays in deficit turn into a surplus for the March quarter, largely on the strength of services exports. I think we stopped the E segment there. So Chinese equity markets stood out in the month of June. You saw roughly around a 16% increase in equity markets in China. And from May onwards, you started seeing that come off. For the last week of May, you started seeing a fair bit of a correction in Chinese equity markets. It came off around 7% or so. Now, it is very important to understand that Chinese macros, China property sector has actually been fairly weak and it continues to remain fairly soft. But most other indicators in China continue to hold up, continue to remain important. So it is important to keep a very close track on China and China macro variables to get a sense as to how the equity portion in China will also move. Now, why is that important? Now, if you look at China, inflation really isn't there, largely on account of the fact that you've seen a property crisis. You are not seeing too much of strength in consumer demand. Most of the strength in China, the 5% plus GDP numbers that you're seeing in China, is largely coming from one, infrastructure projects, a lot of push there. And you're seeing a lot of focus on manufacturing. That has really kept China equities also up, China macros also up. Now, if you look at a long-term relationship of China with respect to inflation, you can see the China PPI numbers, producer price inflation numbers. You can see the Shanghai Shenzhen index and the China inflation numbers. You can see that there is a directional correlation there. They seem to be moving quite hand in hand. And this entire drop that you saw in Chinese equities from around end of 2020, you can see a similar move that happens with China inflation numbers coming down. Now, China inflation numbers are getting much better. From minus 2.5% PPI inflation, it is now almost closer to zero. So this is a narrative that one has to also keep a close eye out for. The second thing is you saw a rally in copper, also based on China news flows and China macro. And if you plot the Shanghai Shenzhen with copper, you can actually see here that the pickup in equities and the move in copper have happened fairly hand in hand. So China remains an important market to look out for. Now, if you look at China equity valuations, they are fairly low. They're around 8-9 PE. And the reason why they are also 8-9 PE is because of the macro concerns markets have. And more importantly, the fact that China has deflation. So when China comes out of this deflation spell, there is a likely possibility that if there is increasing confidence of markets on China, that can see an impact on flows into China, FII equity flows into China. As we speak, the markets in China are waiting for the third plenary session that will probably start around 15th, around sometime next week. Markets are waiting to see what narratives will come out from there. As of now, markets are expecting deepening of reforms to happen in China. Now, we'll just very quickly run through other key highlights from June. So if you look at equity markets in India, you saw in dollar terms, you can see equity markets have done fairly well in India on a year-on-year basis. Almost close to around 20% equity markets in India. The only competitor for India, at least in the developed market space, appears to be the United States. And India equity returns on a year-on-year basis has been much better than all the other peer emerging market countries. Now, if you break this chart that we saw here, if you break that down into quarters, from which quarter has global equity returns seen a fair bit of a pickup? You can see this, if you can call this, I think, teal color. So around the September to December quarter is broadly when all countries have actually seen that bump up in the in equity market returns. Now, if you break it down segment-wise, this has been on a month-on-month basis, just above 6%. This has been your equity market returns for the month of June. Segment-wise, IT, realty, and financials have been the top three contributors, and energy, metals, and PSU banks have actually been the draggers from an index point of view. You have the same, the top three and the bottom three in the charts above here and below here. Now, if you break that down into FII flows, like we saw when we spoke about India debt, you've not really seen very robust inflows into equity from the start of this year when you compare them with the previous calendar years. But if you look at debt inflows, the momentum is fairly strong. And I think it is fair to expect this momentum to continue into the months ahead, especially given India's bond inclusion into the JP Morgan bond indices. The top five, these are the top five sectors that were sold in the month of June and the bottom 5 sectors that were bought into the month of June. Now, the last segment. So this will be a segment, so E.M.I, the investment segment. So we'll just talk about 2 key charts that are extremely important from an investing point of view. Now, you often get to hear from advisors, financial advisors, and even fund managers talking about how 3 to 5 years. 5 years is a time frame that everybody talks about, saying at least stay invested for a 5-year period or more, at least stay invested for a more than 5-year period. This is a number that you keep hearing. Now, let's break these numbers and try and understand where is this 5-year number coming from. Now, if I take rolling returns, so in this chart here, you can see 1-year returns, 1-year rolling returns. We have taken data from December of 1999. Every 1 year, we keep calculating rolling returns all the way until now. Like that, we take a 2-year bucket, 3-year bucket, 5, 6, 7, 10, 14, 15, rolling returns all across. And we try and see what is the probability of negative returns in these time frames. You can see that on a 1-year time frame, there is a 23%. So 23% probability, or rather 23% of the time, your 1-year return, 1-year rolling return has always been negative. If you increase that to a 2-year time frame, it comes down. Your probability of your return being negative is 16%. It drops to 5% on a 3-year basis, 4%, 1.5% on a 4-year basis, and 0.1% when it comes down to a 5-year. And 5-year on, just around 5.5 years or so, from there on, you can see that your probability of making negative returns just becomes 0% if you look at history. Again, we are looking at historical data and trying to make inferences as to how this is likely to be in the future. So the 5-year number comes from this. The fact that if you hold on to your lump sum investment, this is the large cap space as an example. So we have taken the Nifty TRI index, the total return index, now which includes dividends as well. Now, if you stay invested for a minimum time period of just above 5 years, you have never really seen your capital being lost. That is the most important takeaway from an investor's point of view. Now, the second point is that we don't really invest in the markets just to save our capital. We want capital appreciation, but we want to make profits. Then it comes on to this table here. So what do we do here? We are looking at all the time frames across all the same time frames, 1 year to 15 year. What is your probability that your return is negative? The same thing that you saw in the previous chart. You can see that here. Above a 6-year time frame, you have a 0% probability of your return being below 0, of negative returns. Now, we are important as to what is going to be, I think the 7-year to 12-year, I think these 3 are the most important time frames to actually look at. Now, 7% loosely, you can say, is your FD return. What is the probability of hitting FD return? What should be your time frame? 100% of your time, if you're there above 12 years, you've always made 7% in the market. But when you come to equity markets, it's all about probability. 100% is not always there. As long as you're getting a number above 70 or above 80, I think it is a realistic probability. So if you're looking at it you have a 92% probability that any 6-year bucket that you take from December 1999 would have made more than 7%. 92% of the time you've made more than 7% if you have invested in the market for a minimum 6-year period. Now, if you want more than 10% return, or rather, let's take 12% return, because if you look at Nifty and if you look at large cap, in and around just above 12% has actually always been your historical CAGR for the market. So if you look at that, then I think these 2 time frames become important. 67% of the time you have made more than 12% return if you're invested for a 6-year period. 70% of the time you have made more than 12% if you're invested in the market for a 12-year period, and that goes up to 79. So 2 key takeaways from an investor point of view. One, it stresses the importance of staying invested for a minimum 5-year plus period. That increases your possibility, rather it increases your possibility of making positive returns, of not losing your capital. Second, from a profit point of view, return point of view, 6 years, 12 years, 15 years, these seem to be very important time frames that you actually have to look at from an investor point of view. where you are increasing your probability of making that 12% CAGR. I think these are the two most important takeaways from an investment point of view. Now, last chart here is it talks about phases in the market, phase 1 to phase 7, where you can always see here that your phase 1, phase 3, phase 5, phase 7 are much larger in time frame and in size, in quantum, in magnitude, compared to your phase 2, phase 4, and phase 6. So your market is filled with upsides and downsides. The point here is to stay invested in the market for a much longer period of time to take advantage of all these phases that are longer and higher in magnitude. Also take advantage of the phases 2, 4, and 6, where you try to average your cost of investment. And lastly, I think we'll leave you with this quote here. Nature is not in a hurry, yet everything is accomplished. Now, time frame, time horizon is everything in the markets. If you plant a seed, you come back every single day to see if that seed has actually grown into a tree. You would be disappointed every single day. It takes time. So you will have to take care of your investment like you're planting a seed. Time frame is the most important in equity markets. You're in here, you're in the markets for wealth creation, not from a trading point of view, which is why we keep stressing on how it is extremely important to stay invested for a longer period of time and not look at 1 year, 2 year, 3 year time frames. You can look at 1 year, 2 year, 3 year time frames, but if you do look at shorter time frames, you must also be cognizant of the risk that comes with it. And accordingly, you will have to get into asset allocation. We'll talk about that in next month's E.M.I. Till then, it's Arjun Nagarajan signing off. Have a great month ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.